If you currently run a business or decide to start running a business in the future, you should be aware of this strategy that could potentially save you lots of money in the form of interest on your mortgage. Welcome back to my channel. My name is Reese, and in today's video, I'm going to be talking about a method that lots of business owners most likely use to maximize their principal repayments to the bank on a mortgage, and thus also reducing their interest paid to the bank in the process. I had a very interesting conversation not that long ago with one of my friends where the concept we were discussing was talking about how earnings made from a business could be utilized to minimize the interest paid on a personal mortgage. Now, I just want to quickly stop right here and state that I am not a lawyer, nor am I a registered accountant. The conversation that's about to take place in this video is based off of other conversations I have personally had with some of the people involved in those conversations being actual registered accountants and registered lawyers. I just want to state that I am neither of them. If you were to go down the path of implementing what I'm going to discuss in today's video, it would be in your best interest to go and see a registered accountant or a lawyer, depending on the complexity of what you're planning to do based on what I talk about here, to avoid any implications or run-ins with the law. That needs to be stated as my disclaimer. Listen to the story and then go ask your questions to the people who can actually put it in place for you. Just as a sidestep as well, I'm going to quickly go over a concept which feeds into context for today's video, and it's definitely worth understanding as it plays a part in what I'm going to discuss today. It is a taxation rule here within Australia, and it's upheld by the Australian Taxation Office, also known as the ATO, and it's called Division 7A. That's what it's known as, which is part of the Income Tax Assessment Act and is intended to prevent profits or assets being provided to either shareholders or their associates tax-free. Like I said, I would be familiar with what Division 7A is if you are not, because it will provide context throughout today's video. I have left a link down in the description below to a reference that will tell you more about what Division 7A is. Feel free to use that resource, and while you're down there, quickly hit that like and subscribe button. It really does go a long way for the channel. Okay, here is the scenario to contextualize today's discussion. Person A, let's call him Bob, has an investment property within Australia that generates income in the form of rent. That investment property has a mortgage of $500,000, and he is being charged by the bank 3% interest every single year, which means he's paying about $15,000 in interest each financial year. Bob runs a very successful company that he owns outright that is making him somewhere in the realm of $5 million of profit every single year. Now, Bob is very frugal. He does not spend any of that profit money that he earns from the business, not even on himself. It just sits in a business bank account for the sake of holding cash. And if you didn't put it together, Bob isn't all that bright, because $5 million of profit a year could definitely be reinvested into the business to grow his business, but for the sake of the scenario, I'm going to move on. Bob's accountant has given up on trying to convince Bob to use that money in a smart way to grow his business, like I mentioned just before, and instead he's suggested that he parks it in a very clever way to still give him some benefits without risking it in any way, shape, or form. With the right paperwork set up, Bob's accountant tells Bob that he can transfer $500,000 of the business profits from the business bank account into his own personal offset bank account, which is offsetting the $500,000 he owes on his investment property, on one condition, and that is that Bob transfers that $500,000 in full back to his business account before June 30th of the same financial year that it was originally taken out from. If Bob does this, then no tax rules should have been broken, and Bob will have paid off a nice extra chunk of principal from his mortgage, because instead of interest being charged whenever his minimum repayments come out, now instead, he's going to be paying basically 100% principal, which is a really good thing to reduce his debt significantly. In this sense, it seems that from the perspective of the Australian Taxation Office, that they crack down on people who use company money to produce personal income outside of the company. However, reducing interest is not classified as producing income. So ultimately, the idea behind this strategy is to withdraw money from the company account on the 1st of July or as early as possible in that same financial year that it was earned, move it across to the personal bank account and park it there until June 30th or before then, and pay it back in full in the same financial year to maximize the benefits of it. That way, when the financials are prepared, the company has not loaned out any money because it was repaid in full, and come July 1st, you can rinse, repeat. The benefit gained is the reduction in interest for however many days that money sits in that offset account throughout that year. But the cost for doing this is the opportunity cost for the company, where Bob really should be reinvesting the money to build and grow his business instead of parking it in a bank account to save a small amount of interest. One other thing worth mentioning is that there will most likely be a cost involved in making sure that everything is above board, and this would be in the form of paying an accountant to make sure that no rules have been breached. To work out if this would be viable for your own situation, I would be doing the calculation to determine how much money you're going to save in the form of interest on that mortgage. As interest rates rise, this might become a more desirable thing for business owners or people who have a lot of excess cash in their company. It might be an option for them to park it somewhere in the meantime, as things are moving into a bit more of an uncertain territory within the economy. In my own opinion, if the savings exceeded $5,000, I would definitely consider doing this personally. I would look into it a hell of a lot more and make sure that everything is in order to be able to do it. But that's probably where my line of effort would come into play for me to consider actually doing it. Alternatively, if I ever started making a lot of money through, let's use my YouTube channel as the example, if I made big bucks through it, I would absolutely again consider doing this strategy, as I would need to think about how I want to spend the company money. So for the meantime, I might just park it in an offset, again, permitting that everything is legal and I'm allowed to actually do it. Ultimately, from what I have gathered, this could be a decent strategy to reduce interest on a mortgage. I want to reiterate it, it's something that definitely would be worth looking into if it applied to your own individual situation. And for me, I thought it was a pretty interesting concept that came up in discussion, and even though it might only be applicable to a certain number of people, I thought it would be worth talking about in a video. So here we are. With that being said, I don't really have anything else to talk about. I hope you enjoyed today's video. I hope it made you think. I hope I might have potentially taught you something you weren't aware of. And if I did, please hit that like and subscribe button down below. It really does help the channel grow. I really do appreciate the support, and it doesn't go unnoticed. Anyway, I will leave you there. Have a good day, have a good week, and as always, I will see you in the next one. Bye for now.